So my question to you is two things. Let's just say that you've already made that economic decision that yes, hedging makes sense. From your perspective, what are the steps that you take? And then also, do you see that the objection that I hear sometimes, do you see that lessening now with like recent rules or trends in industry?
Right, right. And yeah, the once you've actually made the decision that you have an exposure, that really is sort of the first step. So you have to understand that the risk is there, the exposure is there, how it's going to impact your business. And once you understand that risk is there, then you can start looking at, okay, what are my objectives? How do I want to mitigate that risk? How can I control it better? Those are the first two steps you have to take before you embark on a hedging program. Because, I mean, it's one thing to start, trying to enter into different types of instruments, but you may not really have a good understanding of your overall risk. So what we tend to look at first is, what is the risk? How do you sort of quantify that risk so that you have a good understanding of everything that's there?
I knew I was going to like you.
And then you start addressing the exposures, and then you start addressing the objectives. What do I want to put in place? What actually aligns with our risk management policy?
Right.
And then you start looking at the alternatives and the options of what you can put in place, how effective they would be, going down that road to make sure that you understand that the instruments you're putting in place, what you're really going to lay out as far as this program is going to achieve what you're trying to achieve. And the nice thing about it is, once you start putting that in place, you're constantly looking at it and looking at it and looking at it again to make sure, okay, how accurate is it? How effective is it? Is it really accomplishing what I want? Can we do this a little bit better? So it's always trying to refine it, to tweak it, to make it more accurate, to make it more reflective of what you're really trying to achieve.
So have you seen I hope that more and more, not just companies, but industries are looking at it that way.
They're starting to. They are starting to. When you go back as far as looking at hedge accounting over the last 20, 25 years, it started out on a good note, and then it sort of got a bad rap. What ended up happening was they added some complexity to it. People started trying to use it, and then what ended up happening was a lot of people ended up getting their hands slapped as a result of the fact that they were implementing this, and potentially they were not doing everything the exact way it should have been done, or the proper way it should have been done. So it became sort of like one of those areas that people didn't want to touch for a while. What we have seen over the last probably 5, 6, 7 years is that there's been a movement going back to it. And a lot of that, there's various reasons for it. One, the driver has been really more the Financial Accounting Standards Board, the FASB. And the FASB has been coming out with a lot of changes and regulations and pronouncements that really make it easier to implement this. So before you had this set of requirements that was very stringent. Now they're relaxing it a little bit. They're making it a little more flexible. So companies are starting to come back and take a look and say, you know what, that doesn't look as bad as I thought it was. The other thing I will say that we have always instilled when we do these types of consultations or projects is that hedging is very similar to tax planning. You don't go into a situation related to taxes by doing the transaction and then trying to figure out how to address it after the fact. That's not how you do it. You talk to an advisor, you plan it out, you understand how you're going to approach it. Then you do the transaction, and as at that point, then everything's already been done. You understand how you're going to treat it. You understand how it's going to be effective, how it's going to work. This is the same way. You work with the expectation of, we're going to enter into this particular type of transaction. What are we trying to achieve? How are we going to record it? What is it going to do for us? And then once you actually do the transaction, most of the work is already complete. What companies end up seeing after that is that the amount of time, effort required to manage it going forward, as far as from a hedge accounting perspective, is really not bad at all. But again, it requires that you do the upfront work.
There is also, on that upfront work, there's a technology perspective too. And I think that was part of the bad rap that hedge accounting got, was that when hedge accounting was introduced, it gave rise to a brand new industry in software, which was commodity trading risk management systems. Those things existed so that you could take current pricing and figure out what your accounting entries should be. And they grew into other things which became total risk systems. Well, if you've worked with them before, and we've seen a lot of our competitors' versions of them, and you're talking about like hundreds of thousands, sometimes millions of dollars of implementation to be able to plan ahead. Now we saw an opportunity there, which is, hey, how about we go back to basics and just provide the valuation and integrations with accounting systems that you need. And so I think as the SaaS approach, the web-based, cloud-based approach has sprung up, I feel like we're in a leadership role there in bringing it back to the simplistic terms. So it's encouraging to hear that the rules have been reconsidered, and also on the system side, it's being reconsidered, which makes it a lot easier road to get to hedge accounting.
Right. Yeah, I mean, we've seen so many changes in this area, Matt, over the last 7 years, 8 years, that it's just sort of ripe for it to actually occur now, because I mean, just think about the perspective of what we've gone through over the last 6, 7, 8 years. I mean, we went through a situation and we're still going through a situation with a lot of geopolitical tension. The situation with the U.S. and China, obviously the wars that we're seeing right now in Ukraine and in the Far East, or in Israel, I should say. We're seeing that particular aspect. We're seeing still the lingering effects from the pandemic. We're seeing a rising, for a little while, rising inflation rate that we were seeing and encountering that was impacting all the commodity prices across the board. We were seeing the run to the dollar, which was strengthening the dollar. We were seeing FX prices that were moving considerably as a result. If you have a business and it has any sort of a commodity exposure, you have any debt on your books, you have any sort of international operations, you have anything along those lines, chances are you have a derivative out there, and chances are it's impacting you. That derivative is moving in value considerably as a result. So it's like, this is sort of like a little bit more of a warning, a bell that's going off. Basically now it's like, wait a minute, guys, if you haven't been doing anything up to this point, it's time to consider it, because this is not going to stop. It will most likely continue in this direction for some time. So if you're not taking the proper steps to address it, then really in essence you should be focused a little bit more on what is risk management of your business. That's only prudent.
So if you look at the total portfolio risk that you have as a company, and you mentioned interest rates and FX, and then before we talked about aluminum, and going back to the beverage manufacturer, they may have exposure to corn and sugar and some other things. What types of flexibility do you have in hedge accounting? Would I have to say I'm going to treat all of these commodities the same? Can I pick and choose how I report each?
That's actually one of the big changes that we've seen. So that I'm glad you're sort of pointing that out, because when you look at the most significant change that we have seen in this area has primarily been focused on what they call component hedging. Before, when you were dealing with commodities, you had to take an all-in type of approach. So think about it from this perspective. Let's say you are a tire manufacturer, and as a result, 80% of what goes into that tire is primarily the price of rubber. There's other things that go into it, but that is the vast majority of what's going to basically build up your costs. Well, you would not be able to hedge just on the price of rubber before. You had to hedge on the entire price of the tire, which means you're capturing a lot of other elements that are really not part of the hedging equation. You want to focus more just on the component price, which is the price of rubber, which is really the vast majority of your cost structure. So what they ended up doing was they allowed companies now to start focusing more on components versus the entire totality of it. And what it allowed them to do was they get a more accurate representation. They enter into an instrument that really reflects more of what they're trying to accomplish. And it makes hedge accounting easier because you're not having to jump through some of the hurdles as far as the quantitative tests and what have you that may not work if you're trying to hedge a tire versus a rubber-based derivative. It's not going to work exactly. Now you're basing a little bit more on a one-to-one basis, so your relationships are going to work better. So that's been one of the big drivers that we have seen that has really sort of pushed people back this way and starting to look closer at utilizing this treatment.
So I'm gonna stretch my accounting skills here for a second. So as I recall, if you are not recording the change in your hedging values on your income statement, it traditionally goes to other comprehensive income. Okay. Are there any changes in how you manage that reporting item?
That item is reflective of the settlements of the item that you are hedging against. So, for example, we're talking about a derivative instrument, and that derivative changes in value, and you haven't actually, let's say, let's just use an example. It might be a little bit more straightforward. So let's say you're hedging a variable piece of debt, and you're hedging it with a simple interest rate swap. Okay, so that interest rate swap is going against the debt. You've stabilized the amount that you expect to pay on your interest expense for that debt. But the actual settlements on the actual debt haven't started to occur yet. Let's say they're going to start, in a couple of months. The derivative instrument you've traded, so it's already changing in value. So there's an amount that's going to be reflected in your OCI balance. But that amount is not allowed to start coming out until the actual settlements of the debt itself have occurred. So the item that you are hedging, in this instance, the debt, is what's going to drive the recognition of all those balances that are deferred or that are locked up in OCI. The debt itself is what's going to drive it. If the debt doesn't actually start paying out for a while, then that amount stays in OCI and it moves in OCI. If you start paying down the debt, the amount starts coming out proportionally. So that's really how, and what you think about it from that perspective, what you're accomplishing is the gains and losses related to the change in value of the derivative really, in essence, are going against the actual cash settlements of the debt. So that you're getting a good relationship, a good match between the change in value and the actual payments of the debt, which is what you want.
I mean, that principle has come up several times already. It seems like that the rules that have been changed and the rules that remain are becoming closer aligned with the economic reality of the company. That's wonderful. Look, I would like to move on to thinking about, so you've made the decision to hedge. Now you have to, like you said before, is you need to do some planning in advance so it goes smoothly thereafter. But anything else you want to talk about with current rules and things that have changed there?
The big drivers, I would say, would be there have been a couple of main changes that we've seen. One, there was some guidance that came out, and this dates back a little ways, but it's primarily more for private companies. And what they called it, there is a regulatory board which reports to the FASB, and what that regulatory board is called is the Private Company Council, the PCC is what we call it. And they actually make recommendations specific for accounting guidance to the FASB, which sort of get implemented and codified as far as accounting regulations. They came out with some guidance that made certain types of treatment for hedging easier for small private companies. So that's one of the elements that came out. The other one which came out, which is what we were talking about a little while ago, component hedging, which was one of the accounting standards updates that came out probably about 6 years ago. And it's taken a long time to sort of filter through. It actually didn't get implemented until like 2020 or something like that. But it allowed component hedging, which was one of the big drivers. So commodities, anyone on the commodity side was very happy about that because it made hedge accounting much, much easier to utilize. The other thing that I will say that has changed a lot has been just the whole concept of ineffectiveness. That whole concept went away, which I'm glad it did, because it was hard to conceptualize it. A lot of people had a lot of trouble trying to understand whether something was ineffective or whether it wasn't. And sometimes trying to quantify that caused a lot of problems and concern. So the FASB ended up doing was they ended up getting rid of that concept and saying, look, as long as you can determine that it's highly effective or effective to a certain level, that's all we care about. Okay? And then you don't have to worry about another entry or another actual, recording ineffectiveness, which used to be the big driver that caused problems. The other comment I'll make in regards to changes that we have seen also, and this has been a little bit more recent, was what we've seen in relation to LIBOR transition. The FASB, took it under their advisement that, what we were seeing as far as a lot of companies that were going to be transitioning from a LIBOR-based rate to a SOFR-based rate or an alternative rate. And what ended up happening was they really made a lot of rules much, much easier to implement for a period of time, so that companies that had these instruments really wouldn't be facing a lot of hardship getting through that period of time when they transitioned. So that was very, very helpful to a lot of users that had, various types of fixed income type products and what have you that were LIBOR based. So that's a big driver too. The other comment I'll mention there too is that when you start looking, just if you look at the FASB's website, this has been sort of on the forefront. There are 2 items right now where they are supposed to be coming out with exposure drafts as far as different types of accounting guidance or pronouncements in the next quarter to 2 quarters this year. So we're expecting to see 2 exposure drafts that are coming out, primarily dealing with one with derivatives, the other one with hedge accounting. And then in addition to that, they've got 2 other items on their research list that they are presently looking at, a lot of it related to financial instruments and derivatives. So they're really starting to focus on this a lot more now.
I'm glad you mentioned the LIBOR to SOFR. That was an interesting time because we had a number of customers who had either swaps or caps on LIBOR and had to make the transition to SOFR. And it underscored how simple and flexible hedging is, because these hedges are made with a bank, with a counterparty. They're bilateral, and so that means that renegotiating them is actually fairly straightforward, because you have the same person that you had the so I was pleased that it was so easy, and also you're able to even before you transact be able to see what the profit and loss is on the position, so that you can know what you're getting into.
Right.
So
right.
Even though it was a complicated issue in terms of the transition of that benchmark, it really wasn't that complex when it came to transitioning your hedge program.
No. I'm glad a lot of companies have made it through relatively unscathed. I mean, that's good news, because everyone was very concerned as to the impacts of it. When we were getting into the 2020, 2021 period, everyone was really trying to figure out where we go with all this. And because that is a huge undertaking to try and get rid of pretty much the index that drives a lot of the valuations, a lot of these types of instruments, around the world. So it had a lot of people very concerned. We seem to have come through it pretty smoothly, thank God. And what's nice too is that we've seen also the advent of, term structured rates and things like that that have come now have sort of evolved on the back end of it, where people, when they were going through it, were trying to figure out, well, wait a minute, there are no forward prices for this particular alternative rate. How am I going to do a discounted cash flow model? Where do I get the rates from? So a lot of those markets have evolved, and they've allowed to provide futures pricing, which has factored into term structured rates and what have you. And it's come about rather quickly. So that's very good news.
Okay, so you have a company that knows that they have an economic reason to implement hedging.
Uh-huh.
And so they recognize that there's going to be a reporting component to this. When do they call you? At what point should they really engage you?
You would hope that they're calling us before they do the transaction. Okay, so that's the first thing. Those are the best situations to walk into, because when they call you and they're saying, well, we're contemplating on refinancing our debt, and as a result, we also want to swap part of it. Okay, well, if you haven't done it yet, that makes things so much easier. And that's normally the type of call you want to get up front, right? Because you're working with them through the process, you're helping them, you're advising them, sort of avoiding the pitfalls as you're going through it. But I mean, we see it at all different stages. I mean, that's the ideal situation when you get it up front. Usually it happens, a little bit closer to the transaction. So they've already sort of identified terms. They already have a term sheet that's mapped out. They've been talking to banks already. And as at that point, then it's more like, okay, well, we're contemplating utilizing hedge accounting treatment. What do we need to do? And then it becomes a situation of, having a discussion with them, understanding the objectives, understanding, when they're really going to actually, trigger it or push the button. And then once they do that, that sort of sets everything in motion, because hopefully we would have a lot of the legwork done as far as, laying out the documentation itself, at least prepping a model that's going to address what is the effectiveness, the quantitative test. And then once that's done, then we sort of shift to the administration or the management of it, which means we would potentially help them in drafting notes, laying out disclosures, making sure they understand the entries that they need to be recording, at each subsequent reporting date. Those various elements that come into play after the fact, but the primary focus is getting them through the transaction, making sure that it qualifies for hedge accounting. And then once you've done that, you can sort of take a breather and come back and start looking at the actual reporting requirements that are going to transpire.
The bad part of those large companies that made big headlines in hedging is that it gives rise to a misconception that hedging is a binary event. It's like, I either hedge everything or I don't hedge everything. Right. What I wish most people would realize is that there's a right level to hedge given the financial outcome that you want. You don't have to be that person taking a huge stake in the future of jet prices for it to make sense for your risk.
No, and that's exactly right. I mean, all of it is dependent upon the right level of risk that management feels is appropriate. So, it's not, like you said, an all or none type of situation. Normally when we look at it, their companies are interested in hedging, a portion of those expenses or of those revenues, but you also have to accept the fact that there's risk involved, and there's a portion that you may not want to hedge, and let that move with the markets. Going back to, energy, if you look at energy over the last 20 years, I mean, I remember when I got into this business and we were talking about, in the late 90s, when energy prices, crude prices were down in the $14, $15, $16 a barrel. 8 years later, we were looking at crude prices that were $147. And, you look at it from two perspectives. One, you had a very low price, which obviously everyone is going to be complaining about. And everyone thinks that because you have a high price, that's great. Everyone's doing fantastic. Not necessarily. Not necessarily. I saw companies go under at the low end of the price and at the very high end of the price. Whether it was because they had hedged a portion and then they lost an advantage because the others hadn't hedged, had left a whole bunch of exposure out there and they were able to take advantage of it and they got gobbled up. So there's advantages on both ends. The point being, what is the right level for management and what you feel is the appropriate level of risk for your business.